Hey everyone, welcome back to the Weekend Charts, where I run through the most important charts and themes in markets and investing. Big show for you this week. We got a lot to talk about. Let's start out with that inflation report and look at what's going on with the trend there. So, that downward trend continues in terms of US inflation, but it wasn't as good of a report as people were expecting. So, overall, coming into the report, you had a consensus estimate of 6.2%. And I was asking people before the report, what are you expecting? And over 50% said either 6.2% or below 6.2%. If you voted above 6.2%, you're actually correct. The number came in at 6.4%. So a little bit of a disappointment for the market in terms of market participants thinking we're going to see a bigger drop in inflation. Many of the signs were pointing to perhaps a bigger drop, but that's just the way it's calculated. There's a lot of things going on there. And if we look at the overall trend, though, it's still moving in the right direction. We had 7 consecutive now declines of the CPI's year over year inflation rate, moving down to that 6.4%. And if you remember, we peaked at 9.1% last June. So, pretty meaningful drop so far. The expectation was that it was going to be a bigger drop, but still people are thinking that's going to continue in this direction over the coming months. And importantly, that core rate of inflation, which the Fed looks at very closely, also moving down. So, lowest CPI we've seen since October 2021. And the expectation again is we're going to see a bigger drop in the months to come. So, if we look at the major components of CPI, what's driving that decline from last June, the move down from 9.1% down to 6.4%? Well, it's many different components are moving lower over that time. If we look at used cars, new cars, lower rate of inflation in both of those areas. We look at energy, so gasoline, gas utilities, fuel oil, electricity, all of those moving lower. If we look at apparel and medical care, also lower. So, with the exception of a few categories, most of the things are moving lower. We have shelter being the big one that's moving in, still moving in the opposite direction, now up to 7.9%. And we'll talk a little bit about why that's still moving higher, even though the actual data in terms of the housing costs for Americans, if we look at rents or home prices, are actually moving down, why that shelter number is still going up. And that's putting pressure on that overall CPI number because shelter is such a big component. But if we look at CPI, I think it's important to look at the 6.4% number is still looking at that year over year number. And if we look at the last 6 months or the last 3 months, we're seeing a much lower rate of increase in terms of the rate of inflation, 2% over the last 6 months, 1.6% annualized over the last 3 months. So one number, even though it was a disappointment in terms of the January number for CPI, the trend is still moving in the right direction. And I suspect when we get the number for February, I think that'll calm a lot of people down. So if we're looking at the shelter component, this is a trend we've been talking about month after month, but we have shelter CPI moving in one direction, which is up and up and up, and now at the highest level since 1982 at 7.9%. And then we have actual rents moving in the opposite direction, down, down, down in terms of year over year rate of change, now up only 3% year over year. So, what's going on here? Why are they moving in opposite directions? Well, it's just the way shelter CPI is calculated, it's a lagging indicator. It's using smooth data. It's asking people what they would rent their houses out for. And that causes a lag versus actual data. So, a big question, of course, is when is shelter CPI going to start rolling over? Because when it does, you're going to see a big impact on CPI given that shelter CPI is a third of overall CPI. It's what people spend the most money on. And so, for a clue, perhaps in terms of how much more do we have to go, I like to look at this. This is the rate of appreciation for the U.S. rental market, so up 20% since the start of 2020 versus shelter CPI, now up 14.9%. And as you can see, this gap has been closing, but there's still a gap. So I don't know if the two have to meet each other. And the expectation is that perhaps rents will see maybe another decline or flat line here. But it wouldn't be it wouldn't be unexpected to see shelter CPI continue to move up to close some of that gap. And so the question really is how much, and then when it does start to roll over, how fast does it roll over? But because given its large weight, it's going to have a huge impact when it stops moving higher. And so it's just a question of when. So as long as rents and home prices don't start moving back up in the other direction, you're going to have that lag eventually close, and now you're going to see shelter CPI. So some people are talking about that happening maybe the middle of this year. Some people are saying it'll be earlier. Some people are saying maybe third quarter. But anyway you look at it, assuming that rents and home prices continue their downward trajectory, you're going to start to see at some point this year shelter CPI reflect that and move in the opposite direction. So if we're looking at other components here, we saw that gas prices in the CPI report were actually up year over year because we had a little bounce there in January. But if gas prices hold here, they're around 3.42 a gallon. If they hold into the end of February into March, you're going to start to see big year over year declines because we had that big spike after Russia invaded Ukraine last year. So I suspect this is going to become a tailwind, assuming that we can hold these prices or perhaps even move lower. You're going to start to see big declines for the price of gasoline. That's going to be a driver. Natural gas, as well, as we talked about last week, just the prices really plummeted there. So that will start to be a factor in terms of the gas utility. That's going to have an impact on electricity pricing as well. So as we move throughout the year, again, assuming there's not another spike higher in commodity prices, we're going to start to see that pulled down the rate of CPI and perhaps significantly. So that was pushing CPI up here. If we look at last June when CPI peaked at 9.1%, again, if we can hold in terms of not seeing another increase like that, that year over year comparison is going to start to be a negative and perhaps a very big negative. And just to illustrate that point in terms of commodities, what I did was, this is a tweet I like to do every once in a while, looking at commodity prices, the year over year rate of change. And so this is the most recent one I put out, and only sugar out of the major commodities showed a rate of change higher than the US CPI reading of 6.4%. All of the other major commodities are now lower than the CPI year over year. And what a different picture that is than a year ago. So if we look at February 2022, we had almost all of the major commodities above the rate of inflation. So that was 7.5% last year, almost all of them above it and significantly above it. So gas prices were up 60% year over year last February, crude oil 53%, and you had a number of the agricultural commodities starting to really move higher, and that trend would continue until the peak last June. So very different picture here. We're not yet seeing a huge impact of this in terms of CPI, but again, as the months go by here, you're going to start to see, I think, this really pull it lower, assuming that we don't see another spike higher in commodities. So on that thought, I put out a poll asking people, it's an interesting one, will the overall US inflation rate actually turn negative at some point in the next year? And that, it seems kind of crazy given how high inflation's been. We had the 40-year high just last year. How could it possibly turn negative? But again, if we get to that May, June, July period and we don't see a huge spike in commodities, and at that point we have, let's say, rents and home prices starting to be more reflected in that shelter CPI component, you don't have that as a tailwind higher. Perhaps we're seeing other factors as well. Hopefully the food price inflation comes back down, as we talked about fertilizer prices being a leading indicator there. Maybe that will be helpful. And so is it possible that we could actually see a negative print in terms of CPI at some point over the next year? I think it's possible. And I think 40% here are saying yes, 60% saying no. So I don't know if it would actually get to negative at that point. But the point being that as a comparison to the prior year, especially for the commodity inputs, if we get to that May, June, July area and we don't see another spike, we're going to start to see a move in the other direction. And perhaps it'll be enough to push that overall rate of CPI at some point in the next year to a negative level, which I think would be pretty remarkable. And if you're wondering what the Fed's response might be, well, we're going to talk about that in a little bit. So the Federal Reserve, after this CPI print, the expectations they shifted, and as you might expect, the number came in higher than expected, 6.4%. And now the market's thinking that the Fed is going to stay a little bit higher and go a little bit higher and stay there for a little bit longer. Not a monumental shift, but it was definitely a shift after that CPI print. And what we saw is now the market is pricing in another 25 basis point hike. So before the CPI report, the market was thinking just two more hikes. So a hike in March of 25 basis points, another one in May, and then that's it. Then the pause. And now the market's saying, well, they're not going to stop in May. They're going to do one more in June and go as high as 5.25 to 5.5%. And if we look at Fed funds futures as a probability of the June meeting in terms of what investors are pricing in, and what we see here is a pretty big shift over the last week and a huge shift over the last month. So a month ago, there was a little bit above 6% chance that the Fed would be at 5.25 to 5.5 or above at that June meeting, which would mean essentially three 25 basis point hikes by that point. So very low probability of the Fed hiking three more times just a month ago. If we look at a week ago, we're at 37% for those same odds. And if we look at today, now we're over 50%. So pretty significant shift. Do I expect this to hold into June? It's going to vary significantly. So no, it's not going to stay where it is. It'll either go further higher in terms of the expectations. Let's say if CPI stays more elevated and doesn't come down as fast as people are thinking, but if it does start to show a significant decline, let's say we're in 5% range or lower at that point, I think you're going to see the market shift back, and the Fed might give an indication that they're only going to hike perhaps one more time or two more times. And of course, that would shift it as well. So all of these probabilities change every single day and with every new data point. So I wouldn't read too much into it. But for now, the market's saying not two more hikes, but maybe three more hikes. And we'll talk about this later. That's obviously great news for savers and people invested in treasury bills or have savings accounts, but who this higher interest rate is not good for is people holding debt. And the US government on that point hit another high in terms of their interest expense paid on that public debt outstanding, 783 billion over the last 12 months. So as that debt matures every single month, they have treasury bills maturing, they have some notes maturing, and they have longer term bonds maturing. And as they mature, they're all being issued at higher levels than when they originally were issued. So this is going to continue to move up into the right. And the question is, how much, how long, and will this impact the Fed's decision in terms of how high they're going to go, and perhaps in the future, how quickly they'll start cutting rates again. And as we talk about, when for a long time, when interest rates were zero, people were saying, don't worry about the national debt because it costs nothing to service that debt. The interest rate is zero, interest expense is so low. But now the game is kind of changing here. We're talking about 5% treasury bond yields. And that's a different story when you're borrowing at 5%, obviously, versus 0%. And so, again, it's going to take time because the Federal Reserve, was at 0% for so long, and interest rates were low for so long that a lot of the debt that's outstanding is longer term. So those securities are not going to mature. But there's a good enough portion that's, let's say, 2 years or below where it's going to have an impact. And when those securities mature, again, they're all being reissued at higher yields. So the cost of debt is going to keep going higher. The question is, of course, how much, how fast. And in terms of that, is it affecting policy? So far, doesn't seem to be. The deficit is widening again. We're at almost 1.6 trillion over the last year. So I don't know when this is going to be a big factor for people. There doesn't seem to be any push to do huge, huge bills that are going to be costly here, but there doesn't seem to be any appetite to significantly cut that deficit. So the debt is going to continue to grow as we have a $1.6 trillion deficit. So that the whole notion of a debt ceiling and it's going to stop at 31.4 trillion, that's of course nonsense. They're going to raise the debt ceiling. They have to raise it at some point. They could fight and argue about it for now, but when you have a deficit over $1 trillion, we need to borrow money, and so at some point shortly, you're going to see them raise that debt ceiling, and then they'll play that game again and again. So expect to see that go up, and as that debt increases, that's more debt that's being issued at higher cost, and that's going to add to that interest expense. And the risk there, of course, as we talked about, is if this gets so high that let's say it's over $1 trillion, well, now you're crowding out potential spending in other areas, and you also may have to borrow more money just to pay the interest on that money. So you don't want to get into that situation. So hopefully, they have some discipline in terms of the deficit. Hopefully, interest rates don't go too high, and I think a lot of it's going to be dependent one on the other. So a lot of people are saying the Fed can't go too high because of this factor, and they wouldn't go much higher than, let's say, 5% because it's going to be prohibitive in terms of borrowing. So we'll see what happens there. Something I think it's going to be increasing importance, and as we head into the election in 2024, it's likely to be a bigger topic that's talked about. So the big debate that still exists now, is it going to be a soft landing, a hard landing? And now with the market rallying 20% off the October lows, you have more and more people saying no landing, no recession. Perhaps it was a little bit of a slowdown, but this is not going to be a recession at all. So the data continues to be mixed. We talked last week about all of the positive housing data that's out there, and that's continues to be the strongest argument if you're going to say that there's going to be no recession and no official recession and no landing. But the data in many other areas are looking very much like a recession. So the housing market, number one, definitely looks like a housing recession. We have a 21% decline in housing starts, 31-month low. And if you look at past cycles, housing starts very frequent leading indicator for the economy. So housing starts at some point during the cycle peak, they start moving down, and then with a lag, you see the recession start. We've seen that in a number of cycles going back in history. The question is this peak and then this move lower indicating that perhaps there's going to be a recession ahead? So housing market, just one part of the economy. It doesn't mean necessarily the overall economy has to go into recession, but we're seeing similar data in terms of manufacturing data. If you look at any number of the manufacturing surveys, they're pointing to weakness there, and we're seeing this Philly Fed manufacturing index actually move down to levels that in the past it's only been at either shortly before a recession began or actually in a recession. So all of these recessions here that I put out in red here, 1970, 73, 75, the double dip recession, the early 1980s, 90, 91 recession, 2001, financial crisis, and most recently in 2020, all had this Philly Fed manufacturing index at this level or below. Now, does that mean necessarily we have to be in a recession? No, every time is different. It could certainly be an exception, but again, add that to the housing data, add that to other factors, and they start to build. So the evidence of a potential recession, looking at the yield curve, looking at housing, looking at manufacturing, starting to build here. If we look at industrial production, this is again a reflection of activity in the economy. It's one of the indicators that the NBER looks at in terms of is there a recession, isn't there a recession, and we're not quite there yet in terms of a year-over-year rate of change. So it definitely tends to go negative during recessions if you look at these shaded areas here. So we're not right there just yet, but it's slowing pretty significantly. It's at its lowest growth rate since February 2021. Does a negative number mean it has to be recession? No, we saw over here 2015, 2016 area, it go negative without a recession. So it's not necessarily the case that decline in industrial production means a recession. But again, just another indicator that's perhaps pointing to it. And this one, I think for me, is kind of the test on whether you believe this time is different. And so you're not supposed to say this time is different, because you get into trouble. And people are trying to find ways today to say this time is different, in that the Fed is aggressively hiking rates, and they're trying to bring down demand, but they're saying this time is different. It's not going to lead to recession. And hopefully that's the case. Maybe that's the case. But if we look back in history, every time the Fed has aggressively hiked rates to bring down the CPI when it was over 5%, there was a recession relatively soon, when the Fed hiked rates to bring it down. So this time around, the interesting thing is the Fed funds rate still is below the CPI rate. So Fed, as fast as it's been over the last year in raising rates, still below that CPI. So there's more to go. Obviously, Fed is still planning on hiking at least 2 more times, and now the market's saying maybe 3. But it's incredible that we're here and we're still not above that rate of inflation. Every single time in the past, when inflation was above 5%, the Fed eventually hiked rates above that rate of CPI. So like I've been saying, I think the two are going to cross at some point this year. You're going to see CPI continue to come down. You're going to see the Fed funds rate go up. And then the question for the Fed is, do they stop there? Do they pause? How do they react to that? And I think that depends on the confidence that they have of, will it not just go below the Fed funds rate, but will it continue to go down to their kind of 2% threshold? And so if we look at other areas of the economy, what's the biggest driver? What's going to really push the economy into a recession if it happens? It's going to be the U.S. consumer. And so we got retail sales data again, and everyone was focused on the monthly number, which was above expectations. But if you look at the year-over-year number, and you in particular look at the year-over-year number adjusted for inflation, that really is telling the story here. And the story is one of weakness. So the US consumer, it seems, is finally reaching a point where they're pulling back. So we've talked about the savings rate last year hitting its second lowest level in history. We talked about consumers borrowing rates increasing at a very rapid pace, fastest pace since 2011. And we talked about how that might reach a breaking point. And what we're starting to see is a slowdown in that borrowing. Again, perhaps it's just a short-term data point, but we're seeing a slight slowdown in that borrowing rate, and we're starting to see the savings rate move up a little bit. So we were saying last year, if and when that happened, when consumers stopped going to credit cards in terms of trying to finance that difference between their wage gains and inflation rate, when they stopped doing that and they started to save more, preparing perhaps for worse times, well, that's going to start to really show up in retail sales. And I think that's perhaps what we're seeing now. So again, it's been a few months here now, negative year over year inflation adjusted real retail sales. And if we get a little bit more negative here, it really doesn't have to get much more negative. Then you're talking about levels consistent with recession. So obviously 2020 was just a collapse, but if we look at 2008, 2009 recession or 2001 recession, we saw something similar where you see inflation adjusted retail sales really move lower. And the big difference today, of course, is that because their inflation rate is still so high, above 6%, you really have to look at that inflation adjusted number. Nominal retail sales still slowing. Now we're below the historical average at 3.9% year over year. But again, you have to look at that inflation number, inflation adjusted number. And if we look at yearly table here of retail sales, 2022, negative 1.2% after adjusting for inflation, before plus 5.2%. So very different story. Over here, nominally, Retail sales look great in 2022 on a real basis, adjusted for inflation, pretty weak. Certainly not 2008 weak, but weak enough where that's what people should be focused on, in my view. The US consumer is very important to the overall economy. If we're going to go into recession, you're going to see a more meaningful pullback. People are wondering, though, will the US consumer pull back if they don't lose their job, if we don't see a rise in unemployment? And the answer to that, I think, is they already are starting to pull back despite no increase in unemployment, despite strong jobs data. So perhaps we could have a slowdown without a huge jobs recession. Hopefully that's the case. So it's going to be a very different cycle and recession, perhaps, than people are thinking about if they're comparing to prior data points, because of all the factors we talked about, with just so many job openings, so many companies still needing employees. Very different picture. But that doesn't mean that the U.S. consumer, it doesn't mean that they won't pull back at some point here in the next year, regardless of employment. They seem to already be doing that. So I want to talk about profitability, and this has been a big factor during earnings season. So we've seen overall S&P 500 earnings continue to move lower. So as more companies have reported, we've seen this gap EPS number for the S&P 500 continue to come down, now down 29% year over year. So pretty sizable decline Q4 over Q4. That's the third consecutive year over year decline. And what we're seeing in the market is the market's starting to really reward companies that are beating on the bottom line. So beating in terms of earnings per share. And they're not as focused on that top line revenue number that they had been. If we look at, let's say, 2020 and 2021, it was all about top line growth. Now it's really show me the earnings, show me the net income. And so I think two really good examples of this are, number one, Airbnb. Be huge beat here in terms of profitability. It was the first profitable calendar year ever, 1.8 billion in excess, and revenue growth very strong, of course, as well in 2022. But the market really responded to that net income number, that profitability number, and so it'd be interesting to see if this trend continues in terms of this bifurcation. What we're seeing on the other side is companies like Lyft really get destroyed on another year of negative net income. So another net loss for Lyft every year, pretty much. Lyft has lost money. It continued to do so. And despite pretty good jump in its revenues. Revenues hit a new high, a little over 4 billion for 2022. Market not responding to that. Big gap down after earnings for Lyft. So we're definitely at the stage of the cycle where profits matter, earnings matter. You're seeing all of these technology companies right size, do labor cuts. They're doing cost cutting as well. That's going to help profitability, and the market's been rewarding companies that have done that very quickly with higher share prices. So very interesting thing we're seeing here with the market caring about profitability, caring about net income again. Some people would argue interest rates have to factor into that as well. But regardless, it's kind of a change in the mentality of market participants, an important one. So let's talk about the housing market. So we had a huge housing investment boom in 2020, 2021, and now we're seeing the flip side of that. So this is a chart showing you the investor home purchases year over year rate of change. As you can see, just enormous increases in investors' purchases of homes after the initial stages of the pandemic. And you just saw the opposite of that, the largest year over year decline, according to Redfin, going back to 2000. So very different picture here, 46% decline year over year in terms of the number of homes that are bought by investors. And this chart just illustrates that number over time. And now we're below kind of pre-pandemic levels. So we had that initial downturn very quickly. Then we had a surge to record levels of purchases from investors, and now a move back lower. And what's driving a big part of this, of course, is affordability. It's much harder to finance a home. Cost of financing much higher. 30-year mortgage rate, even though it's down from its peak, its cycle peak over here, it's still at 6.3%, more than double where we were at the lows here, 2.65%. So affordability, big factor. And now investors are starting to see, as they saw in 2006, that the notion that home prices only go up is a foolish notion. Home prices can go down. They are going down. They're down nationally around 11%. If we look at Redfin data from their peak last June, and when investors see that, their psychology changes. So it was home prices can only go up during 2020, 2021, because that's what they had done for a decade at that point. And you had a 40% increase in a 2 year period. And now we're seeing the flip side of that. So investors having a harder time to finance homes, and their expectations in terms of price increases are down. So that just has led to a collapse in demand from investors. So let's talk about trade deficit. Interesting data point here. 948 billion US trade deficit last year. That was the highest we've ever seen with data going back to 1992. So very big trade deficit last year. And with most countries, it widened. China, it hit, I think, its second highest level ever, over 300 billion in deficit with China alone. And what was driving that? Just huge consumer demand coming off of the stimulus levels. A lot of it happened in the first half of last year. Then we saw a real reversal. Another part of that was the strength in the dollar makes goods from overseas cheaper for Americans. So you had a currency impact as well. But we're kind of seeing a very rapid mean reversion in the other direction. So part of this is, again, consumer is spending less. They're starting to pull back, and we're seeing all of that extra money that was going overseas starting to pull back here. So I would expect to see a much lower annual number for 2023, and we'll see if this trend continues. The dollar, of course, has started moving in the opposite direction. Of course, has pulled back a lot from its peak last year, and that's making overseas goods more expensive as well. So pretty interesting that given the rhetoric out there in terms of the U.S. needs to build up its manufacturing base again and not be so dependent on overseas, as we learned during the pandemic, all makes sense, particularly semiconductor industry. A lot of people talking about, given all of that, we had a record trade deficit in 2022. So pretty interesting there. We'll see again if that is talked about heading into the 2024 elections as a major issue as well. This is something interesting that I noted. So Google's had some trouble this year. The stock price is under a little bit of pressure, especially with they released their version of AI and it wasn't received well by the markets. And they're thinking there's going to be more competition there. Google's growth, of course, is slowing. Had revenue growth only 1% year over year. Profits were down versus the prior year. If we look at 2022 versus 2021. So a number of factors putting pressure on Google, but I just pulled up its PE ratio the other day, 21 times earnings, which is around what the market is selling for, the S&P as a whole. But what was interesting to me is that there's many companies in the consumer staples sector that are trading at higher multiples and some much higher multiples than Google. So is there a bubble, I was asking, in a safety trade where these consumer staples, which tend to be more consistent in terms of their revenues, and last year everyone's thinking the economy is going to go into a recession, or maybe it's already in a recession, so they're bidding up these companies, and just pretty interesting to see things like Clorox trading at a 44 times earnings, and Colgate 34 times earnings, and Google, which has been one of the great growth companies in history, only trading at 21 times earnings relative to these companies. So we'll see what happens if this starts to revert. I suspect that a lot of money poured in to this sector last year. It actually was one of the best performing sectors in 2022 because during recessions, during downturns, people look for consistent, safe revenues, but maybe they state their welcome there. Maybe they push these valuation multiples too high. We'll have to see. But pretty interesting to see them significantly higher than a company like Google. So I want to end with something positive, as I like to do. And for a long time, there was this saying in markets, Tina, there is no alternative. And that really, the saying was driven by the idea that interest rates were at zero. The Fed held interest rates at 0% for much of the last decade. And so there is no alternative to taking risk. And so the saying was, you have to go out, you have to either reach for yield or buy equities because there is no alternative. You're going to earn nothing on your cash if you're not investing in something more speculative. And today, that's really changed 180 degrees in a very short period of time. There is now an alternative for the first time, really since 2007, that investors can turn to and get some level of yield without going to equities, without going to high yield bonds. They can do it in the US Treasury market. So 6 month Treasury bills now have a yield above 5%. That's the first time we've seen any Treasury bond yield above 5% since 2007. So pretty long time. You have to go back before the financial crisis, 2007, to find a yield that high. And if you're a saver and you have savings account, obviously you're if you did nothing over the past year, you might still have a pretty low yield. And how we know that is they look at national average. So Bankrate puts this out weekly, and the most recent national average for people who have savings account are 0.23%. So still very low. And what's driving that? Well, just inertia. People have an account, they probably haven't looked at it. They assume that it hasn't gone up because it didn't go up for a long time. And for much of the last 10 years, the Fed had interest rates at zero. So what was the point of doing anything about it? Well, today, very quickly, in a 1 year period, we've gone from pretty much zero to 5% now on the highest yielding bank that I could find in terms of FDIC insured banks offering a yield now over 5%. That's the first time that you can find that since 2007. So good news if you have extra money that's in a savings account. This is an emergency account for you, or it's any number of things. You're waiting to buy a house. Well, now you're at least being paid something, the highest level actually since 2007 in both treasury bills and just FDIC insured savings accounts. So we'll end it right there. Have a great week, everyone. Thanks for joining. If you like the content, subscribe to the channel, and we'll see you next time. Thanks.